Good evening, members. I welcome you all on behalf of the Management Committee for the study circle meeting on the strategy on the subject corporate valuations, and to build upon this, we have with us Dr. Rajesh Kumar. I request CA Rajesh to escort the speaker and present him a plural. Thank you, sir. Members, I have a privilege of introducing today's speaker, Dr. V. Rajesh Kumar. Rajesh Kumar is a MCom graduate from Bangalore University. He has got a doctorate in the area of strategy. While accounting and taxation are his area of expertise, finance is his passion. He has 32 years of experience in teaching at graduates, postgraduates, and professional levels, and has served various institutions in different capacities, such as Institute of Management, Bangalore University, Chanukya University, Alliance University, RD University, to name a few. He is a faculty of Strategic Financial Management and the Bangalore branch at Institute of Chartered Accountants of India. He has authored books on financial management and indirect taxes for the requirements of professional courses, and co-authored textbooks on accounting, finance and taxation for the requirements of various universities. He is the first Indian professor to be selected for the International Management Teachers Academy training on the case analysis on writing conducted by the Central East European Management Development Association at IECD. Weld School of Management, Slovenia in 2006. He has presented papers on various national and international conferences and published articles on repute journals. His paper on capital asset pricing model was selected for the international conference at Harvard University, Cambridge, United States. During the year 2011, his papers on stock markets was selected for the international conference at National University of Singapore during 2024. Dr. Rajesh also has a rich experience in research, consultancy and training, both at the academic level and corporate levels. He has conducted students development programs and faculty development programs in various educational institutions, and has conducted training programs for executives of various companies such as Wipro, Godrej, FCG, Honeywell, KPCL, Force Engineering, Triveni Engineering, so on. He is associated as a resource person for the non-finance executives programs of the Bangalore branch of the Institute of Chartered Accountants of India. He is a founder of Vittam Pravina Gurushala, a finance expert academy, an academy engaged in spreading finance knowledge to students, faculty, corporate, and all other interested in the areas of finance. With this brief introduction, I present before you Dr. V. Rajesh Kumar.
A very good evening, ladies and gentlemen.
Good evening.
At the outset, I thank Honorable Chairman of Bangalore branch, Shri Manjunath, the other office bearers, my good friends, and it's happy to see many familiar faces in this crowd. Thank you for this opportunity to share something I know about this very, very exciting area of corporate valuation. Before we begin and before we get the set, Girish, but we should have started in a much more pleasant note, considering and depreciation inclusive. We get operating costs, operating revenues minus operating cost. What do we get, sir? Operating profit, popularly referred as EBIT, EBIT. Simple. But it's from here something interesting happens. In income statement from EBIT, what do we do, sir? From EBIT, what do we show? Less interest. But our purpose is not to prepare income statement to find something called free cash flow to the firm. So what we do, from EBIT, we deduct tax on EBIT. So we don't consider interest for whatsoever reason, which we'll see later. Tax on EBIT. Now this is another challenge. In income statement, the tax what we have is tax on EBT, profits before tax. It's a tax on that. But here what we need is tax on EBIT. How to find? So a simple adjustment to be done. A simple commonsensical adjustment which you can calculate by itself. So what we do is take the tax as given in the income statement, which is tax on EBT. But EBIT includes not only operating profits, even non-operating incomes as well. So if there is any non-operating income, deduct tax on that. And in case any non-operating expenses have been deducted, add the tax on that. That's a simple adjustment to be carried out. Now once you do this, you get something called NOPAT. And let's remember this term very carefully. NOPAT, by expansion, is net operating profits after taxes. Net operating profits after taxes. Add back depreciation. By the way, what is depreciation, sir? Of course, I'm questioning a very wrong crowd. I know, this is not the crowd I should question this, but then, this is one question quite often 99% of candidates in interview falter with, go wrong. And depreciation, I'm sure all of us know, is not an expenditure, it's a provision for replacement of existing fixed asset with the end of the useful life. It's a non-cash item. Since we need cash flows, add back, we get what is called cash flow, cash profits. Things get more interesting here. We need free cash flow, not just cash flow. So what is this? Now, from the cash profits available, after adding back depreciation, profits on hand, cash profits, deduct what has been reinvested by the company in its assets. Now, in what will a company reinvest, a business will reinvest? One, fixed assets, or what we call capex. But we should consider something called gross capex. How to arrive at it? Here's a small adjustment. In the balance sheet, we have fixed assets. I'm sure we know is net fixed assets. So if I take a difference, let's say fixed assets last year was 1 lakh, this year was 1,40,000. 40,000 is capital expenditure but net. But what it is? Gross. But how to arrive at that? There is a small template or a format available to identify that. And everything can be identified just from financial statements. We don't need any other information, insider information. From financial statements we can identify all this. Deduct that. Also deduct any investment in working capital, additional investment in working capital. How do we arrive at working capital, sir? What's the simplest formula for working capital? Current assets minus current liability. So let's say last year it was current assets minus current liability was 10 lakh, this year 12 lakh. So this year further 2 lakh has been invested in working capital. Deduct that. We get what is called free cash flow. But till now, since we take only operating items, we get operating free cash flow, operating FCF. But we need just free cash flow. What is the meaning of free cash flow? Profits on hand after reinvestment. So after considering reinvestment was the profits on hand. And this can be used for any purpose. Reinvestment has been taken care of. What to do with this? Company is free to decide. That's why it is called free cash flows. Add to this any non-operating income after tax. So you get what's the free cash flows available. And this is the metric which denotes a lot of things for a business. Not EBITDA, not net profits, not those items, cash flow. I'm sure all of us know there's a very beautiful statement in accounting. It says, in an income statement, top line is vanity, bottom line is sanity, cash flow is reality. And free cash flow is even further reality because this is actually what gives a very interesting direction to business. Right. We get free cash flows, wonderful. But, and as I said, Should I make any effort to calculate this? Not necessary. Today, any databases if you take, including the free databases like Yahoo Finance, etc., we get free cash flows made available. Annual reports give us what is the free cash flow. So it's not something we should struggle to calculate. But what is important is, it's not we need this year's cash flow, we don't need present cash flow, we need future free cash flows. Now, how to go ahead with that? So, just for, so let's say year, 0 year, 0 year is current. So we know the free cash flows, FCFF, let's say 100 lakhs. Okay. 100 lakhs, whatever the number. Okay. But now, I don't need for this year, I need for the future period. How to estimate? And it's a future, for what period to estimate? What is the life of a business? What's the lifespan of a business entity? Infinitely, forever, going concern, perpetuity. So, can't keep on forecasting forever. So, to forecast future free cash flow, we need two things. One, for what horizon I should forecast, what period I should forecast, and two, how to forecast. Now, can you take same 100 lakhs or 100 crores for every year? Obviously not. Any business expects growth to happen. So, we need to identify what's the growth rate that can happen. Firstly, what's the horizon we should consider? So, all these, as I said, are the practices which we get to see. So, let's notice that. So, please see. One report from E&Y is in Indian context. Then there is one more report from KPMG which is in the global context. Let us see both. So, typically, Indian context, the horizon period is 5 years. Any standard? Absolutely no standard. That's exactly the reason I said subjective. I value, you value, definitely it's not the same. For sure, a lot of subjectivity. But general standards, if we speak something which is found to be appropriate and useful, so 5 years. But there are 20% of the companies which say up to 3 years is good enough. There are some who say 10 years is required. But a general standard practice is to go for 5 years estimation. So, let's say 5 years. So, if I can estimate for 5 years, but does it give me value of the business? Absolutely not. Why only 5 years or why only 10 years? Now, this 5 years or 10 years is called explicit forecast period. Explicit forecast period. Beyond this, you may not do good justice in forecasting. Maybe in some cases up to 10 years may be fine, but you may not be able to do good justice. So what we do, we forecast for 5, 8, 10, whatever the period agreed upon. We also forecast for the remaining period till the end of its life, what may be the free cash flows, and the value for that period we call as terminal value. So we find value for what is called horizon period, explicit forecast period, value for the remaining period value is called terminal value, and then we get the value. So I need to now know 3 things. One, horizon we discussed. How to estimate for the horizon, the explicit forecast for 5 years, how to estimate for that period, and how to find what is called terminal value for the remaining period. Now, first let us see how to estimate for this period. So we need for this what is called growth rates. No business is constant, every business grows. Some businesses may have negative growth, but still it's a growth, it's negative. But generally what do we expect to happen? A positive growth. Now the question arises, what growth rate can I consider? What's the rate we should consider? Now, this is the practice. We take something called corporate growth rate. Some companies, some values take 2 growth rates called corporate growth rate and industry growth rate. And for terminal value, they take what is called economic growth rate. So to forecast the free cash flows for future, broadly these are the 3 rates that will be considered. Let's see one by one and see what is considered. So Okay, go back to this. What's the growth rate they consider? I'll show that how to find. Now, what is this corporate growth rate? At what rate our company is expected to grow? Now, again, it can be subjective. Industry to industry it can differ, but I'm not talking about industry growth, I'm talking about corporate growth rate. And there's a simple model, what is considered very, very effective model. Wonderful studies have happened to justify this is the best metric to estimate corporate growth rate, and this is how it is estimated. G, which is considered as the growth rate, and this simple model, simple formula called G is equal to BR. It looks like simple formula, but trust me, all these are more common sense. Just we take help of the formula. Now, what is B in this? B is retention ratio. R is ROE. Now, ROE, I'm sure all of us know, is considered the best metric to assess the direction which a business is going towards. So simple, and it's readily available. Normally the practice is last 3 or 5 years we take average ROE. So usually 5-year period is what is generally suggested, and getting ROE is not difficult. I'll show some databases where you can instantly take it. Annual reports give ROE for the last 10 years at least, usually take last 5 years and take. So let's say just example, last 5 years the ROE is 20%. But what is this retention ratio? It's complement of dividend payout ratio. So what is dividend payout ratio? DPS by EPS. What is EPS, sir? Earning per share. Let's say 5 rupees is earning per share, and let's say company is paying 2 rupees as dividend per share. So 2 by 5, 40% is DPR, dividend payout ratio. If 40% of earnings is paid, remaining 60% is retained, retention. So 1 minus DPR is what we call as retention ratio. So in this example, I said 60%. Now, B into R, 60% or 20%. So 12% is what is called corporate growth rate, is also called sustainable growth. All this is something we can calculate just keeping annual report with us. Let's always keep in mind one point, and a very interesting quotation. It says, cost is a fact, price is a policy, value is a notion. What are the value fact is very notional, very subjective. Nothing, literally nothing, be it business, be it IP, be it preferences, anything, the value what you find is not a number, it's a range. What is a justifiable range is all that we should work it out. So, when we calculate any of these numbers, it's not very rigid, but depending on the context, what may be the exact this thing you can take, and that's why normally what we do scenario analysis, we take different scenario, different growth rates, simulations, and arrive at different possible values. But how do we arrive at it? This is like this. Right. Now let's say 12% is the growth rate. So what I do, I forecast taking this 12% for next 5 years. Now, should I go with this? That's a choice. Now there are few who say, no, don't go with corporate growth rate. At this point of time, there's a growth rate you have, but as you go further, you will merge with industry growth rate. So better you consider that. And there are lots of studies which show what are the industry growth rates. Growth rate. Let's see, sector-wise, and this is the global context. The numbers, what is the global context, are smaller. In the context, it is much bigger for all the reasons which we can think of. Be aware, we have numbers available. I'm sure all of us would have heard of this website by Ministry of Commerce called IBEF, India Brand Equity Foundation, ibef.org. Go there, you can download reports for every industry, latest reports, quarterly reports, monthly reports are available. And one aspect which they cover is was expected growth rate for each industry. It's available. I'll show them with time periods. So Well, some say they consider corporate growth rate. Some say better don't take risk, let us be rigid, let us be conventional, let us go for industry growth rate. So that's why subjectivity which is in. But consider this and estimate. Now for time being, for simplicity, I'll take this. So I'll say 12%. So let's say 5 years for estimate. So now, can I take for some period corporate growth rate, remaining period industry growth rate? Yes, excellent. This is what we call two-phase growth. So for some period, we consider corporate growth rate, for remaining period, take industry growth rate. Now that's a possibility. So 5 years is not rigid. Take any longer period. Take corporate growth rate or industry growth rate or a combination of the two. So please visualize how each of us can have our own values just from this component. Great. I've estimated free cash flows. I can estimate for 8 years, 10 years, whatsoever. Now, I should discount this, but then life of business is not just 5 years, it goes even beyond. So, I don't need value only for 5 years and even value for the remaining period. The remaining period is what we call as terminal value. The value for the remaining period. So, any business, our own business is what we run. There is no end. So, I can't put a number, it could be 100 years, 400 years, it could. Just taking 5 years, are you able to do justice? No. But I can't keep on estimating. So, for the remaining period, the value what we calculate is called terminal value. Now, for this terminal value again, I need to know at what rate the growth can happen and how to find this terminal value. So, how do we estimate value for the remaining period? This is where the foundations in finance come into picture. I've been teaching first year from 1998, started from this. At that time this was a bigger hall. And from then, that was what I observed. CA, those who pursue, even later those who practice, not everyone, with a lot of exceptions. Focus is more on accounting, taxation, audit, not on finance. And this is what I realized, just because of limited knowledge in finance, whatever they can do for companies beyond accounting auditing, probably it's not getting leveraged. And those who have, trust me, the kind of validation they're able to provide to their clients is immense. And that calls for certain background of finance, and one such background is, I'm sure all of us know, time value of money. And there's an essential foundation, anything related to finance, including our own personal investments, savings, anything that is the key. So there is one technique called perpetuity method or garden growth method. So the industry practitioners and the investment bankers unanimously say they use to find terminal value is perpetual growth method. And going by that, so this is 50+% of industry and more than 60% of investment bankers who actually do the valuation use this method. And according to this method, terminal value is very simple. So if it is 5 years is the horizon period, then take 6th year free cash flow. I guess you have estimated, take 6th year divided by discount rate minus growth rate. Discount rate minus growth rate. A simple form. Now, how should I estimate for next year? What is the free cash flows? Till 5th year we have estimated. What should I take? So, all these studies, which has, and particularly the KPMG study, has captured at the global context, especially the Western countries. So, they consider, just take last year, the 5th year in our example, what was the free cash flows as the next year, or use the same growth rate, or use economic growth. Because going forward, we can't achieve the same growth rate forever, so we merge with economic growth. What is our economic growth rate at this point of time? 6%, 6 to 7%. But again, Western economies it's much lesser. So consider that. So let's say example that. So in this case, I'll say 6%. So the free cash flows for 6th year will be this number 176.23 plus 6%. Suppose. Again, lot of subjectivity. I can take a very rigid number. I don't want to assume too big a growth. If I'm very confident that my business, my industry will go further, I can take a bigger number whatsoever. Estimate. So the growth rate for the remaining period estimated. So if you can recollect, in this example, I took 12% for the horizon period, and for the remaining period I am assuming 6%. But I repeat again and again, subjectivity element. But then comes major question, what should I take as a discount rate? This is the key, and most often these free cash flows are established. We don't see too much variations because most of them are in sync and consider similar values, similar growth rates. But quite often the problem happens with the discount rate. Now, what is taken as discount rate? Again, studies show so many options. Some take a thumb rule rate, anything that comes to their mind, an arbitrary rate, but most popular discount rate that is considered is WACC. What is this, sir? WACC, weighted average cost of capital. Estimating this is a very big challenge for any company, but once again today we have such wonderful system that is established. We don't have too much worry, and today there are a lot of support that is made available. So just to show you, firstly, this is the annual report of HO, the latest 24-25 annual report. And one annual report I like the most. If we can make, since I teach for MBA, our students analyze this annual report, trust me, they have the ability to read any annual report. So comprehensive, so comprehensive. One point of time, what purpose Infosys annual report would serve, today it serves that purpose actually. Very comprehensive. What all a person would like to know, see in an annual report, everything available. And one component that includes EVA, which all of us know, and I'm sure all of us know, at least 5 years or 10 years down the line, literally every single technique, tool available in finance will be replaced by EVA. That's the power of this technique. And here, they clearly show how weighted average capital is calculated, which I'll explain. And whatever I explain is exactly what is found. But we don't have to even bother about this. Today we have studies which help us to find for each sector wise what is the WACC. So this is just a snapshot. Lot of studies conducted by many agencies, and the latest edition is 6th edition. So industry wise what's the WACC is available. But then can I directly consider what is for the industry? So it's essential that you have an idea how to do this. So this is how we estimate WACC, KDWD plus KEW. I'm sure all of us know what is KD, sir? Cost of debt, KE cost of equity, weights of debt and equity, the debt equity ratio. How to estimate this? Now, KD, most often we assume the rate of interest that what we pay for the debt we have is what should be considered, which is not applied. So, if I have to show you what is done in HUL, let's read this. Cost of debt is taken as effective rate of interest applicable to a AAA rated company like HUL. But HUL doesn't have any debt at all. I'll show you. It doesn't have any debt. Still, it considers debt equity. Can you see? Average debt 0. Still, it has to ascertain. So, how do any company and what is the appropriate way to ascertain? For any company, if you have to get cost of debt, identify what is the credit rating of the company available. Just Google search will tell us for any company what's the credit rating. Annual reports will tell us what's the credit rating. Most of listed companies come under AAA, AA whatsoever, but problem will be not listed, which is our issue which we'll see. And obviously AAA rated company, risk is less, so expected return is less, so cost will be lesser. Vis-a-vis a company rated B, B minus, etc., which indicates higher risk, so high cost of debt. Now, where can I find this? So there are sources in the markets. If you can go to NSE or BSE, National Stock Exchange, Bombay Stock Exchange. Along with stocks, bonds are also traded as well, and we get data. Each type of bond, a AAA rated bond, each bond, what is the yield is made available. So if you can identify what's the, for AAA rated, what's the average yield, for AA, what's the average yield, I can find the cost. So this is the usual practice. So again to show.
Sir, one question.
Yeah, please, sir, please.
Suppose the company is paying, let's say, 14% rate of on debt, and then if we go with this, it's to 10%. So what rate we should take?
So for valuation, it is different from our payments actually. What is paid is also captured in a different place. So for valuation, what is suggested is, for finding WSCC, what is suggested is go with this, because this 14%, very few cases it is fixed rate. Quite often it is flexible. So what you pay is not what you consider for calculating WSCC. It is captured in other places, what you pay.
On the interest.
Not the interest. But again, sir, subjective. If you say, I will take that only, any law which says no, you should not, you can. But why this is considered is keeping long term in mind, because all these valuations are long term. So what holds good for long run is what is considered, and that is what is satisfied. So if you have to show this study, so if you could see, sir, intent context, KD used for analysis is 9%. As listed companies considered in each sector having credit rating in the range of AAA to A. So credit rating is the criteria. So while companies, industries have debt, and the rate of interest could be higher or lower, what you consider is this. I'll share all these documents, sir. I'll share it with Girish and we can later use this as well. So that's a wonderful question, sir, but this is what we consider. But then, this is what is generally practiced. Can't we take something else? Yes, that's always a choice. If I am strongly convinced that I should take only 14%, this I may not be able to do justice, it's always a choice that we have. Great. So this is cost of debt. But now, the challenge is always with the next component, cost of equity. So cost of debt, it's based on credit rating, and just now I showed you the number. Indian context, 9% is usually what is considered cost of debt again. But company to company, it should differ, it will differ. But let's say I'll go with the general norm and take 9%, it's fine. But it's all our choice. Now, KE, cost of equity. This is big area of concern. In fact, I said earlier, WSCC is a problem, but in WSCC the problem is with cost of equity. Just for understanding, sir, what is the meaning of cost of equity? What is the meaning of cost of equity? What cost? We can raise the fund, okay. Something close. What IRR is supposed to give to the shareholders? Technically speaking, cost of equity is rate of return expected by shareholders. What they expect is what we pay, of course. So, what the rate of return expected? Now, how to arrive at this rate of return expected? So, again, all these studies, KPMG shows very clearly, many methods are followed, but the best method used to estimate cost of equity is something called CAPM. Any ideas of what's the full form of this CAPM? Capital Asset Pricing Model. So HUL, what I am showing you, cost of equity. You'll see they don't mention CAPM, but once I mention what it is, you will get to see. So according to CAPM, cost of equity, let me repeat, rate of return expected by shareholders is risk-free rate plus something called beta into RM minus R, or let's say into market risk premium. this is a farm. Now, very briefly I'll explain, I'll not take much time on this, but please explain. So, as a shareholder of a company, what's the rate of return I should expect from my company? That's the meaning of cost of equity. Now, any investor, what's the minimum rate of return they'd like to earn from the investment? Risk-free rate. Without taking any risk, that's what we can get. So that's the minimum rate of return any business, anyone would expect. But having invested in shares which are risky, I would like to expect a little more, which is what we call as premium. So, what's the starting point to find rate of return expected by shareholders? Risk-free rate. What denotes risk-free rate, sir? What denotes risk-free rate? Government securities? Rate of return on government issued bonds and securities. Well, government issues both short-term securities, treasury bills, even for 90 days, and long run. Which one should I consider, sir? And each of these has its own rate. Since valuation is meant for long term, since all this is for long term, the standard practice is to consider on long term, the longest term issued by each of the concerned government, what is the rate. Now, where can I find this? So, who issues bonds on behalf of government? RBI. So, this is something you can download from RBI website, which I just did this morning. So, this is a list which shows at this point of time, what are the securities, government securities outstanding, payable to the government, loans raised, which is to be paid. So, as of 2025-26, which need to be paid, etc. And there's one I highlighted in red. Now, this was the latest raised government bonds or the latest loan raised by the government, bonds issued 15th April 2025. When does it mature? So, as of now, 50 days is the longest term government security issued by government. It was 40 years before this. Now, if you could see, 2023, first time they issued 50-year bond. This is the second tranche that they have issued. So, this is the longest as of now that's available in Indian context. Any government for that matter, 40 to 50 years is the longest term. Now, sir, on this, what is the rate we can see? 6 points. So, at this point of time, but this 2.5 months back, so obviously there is always that adjustment that happened. So approximately it's a 7% is the risk rate. So, for as the starting point, as a shareholder, what's the rate of return you should expect? So 6.9 or with a 7%. But as a shareholder, this is not adequate. Without taking risk, I can get this much. Shares are riskiest investment, highly risky. I can make 10 times of money. I can lose everything I've invested, highly risky. So because I've invested in risky securities, I like to expect something extra. That extra is what you call as premium. But then, how much premium? Each shareholder, each investor, I may have my own premium to be added. How to standardize? So this model, CAPM says, if you go to each shareholder, you can't come to a conclusion. The place where all shareholders meet is market. It says, find what is the premium given by the market. That's called market risk premium. What's the premium given by the stock market? Now to get premium given by the stock market, it says, find the rate of return given by the stock market. What's the return? If you invest in stock market, not any particular stock market, what's the rate of return it's giving over and above risk-free rate. That's the extra return we can expect. But then the question is, how can I find the extra return given by stock market? Can I take the entire market? So BSE and NSE are two markets which we are very familiar with. Currently, those are the only two which are active from some commodity markets. So what's the rate of return in the stock market? I need to gather from either from BSE or NSE. What should I consider? So we can't consider the entire market. So we take something to represent the market, a proxy, which is called index. So which are the two very popular indexes we are aware of. 24/7 channels keep telling us about that. Sensex, Nifty. So I downloaded one data from Sensex. All this from BSE website you can download. Just don't want to waste time showing how to download, etc. But so this is the data available. Sensex. And what does Sensex mean? Simple words. Index compared to base year, what is the value in the current year? And for Sensex 1980 was the base year, 79 was the base year, sorry. 100 was the base figure. So if it invested 100 rupees in Bombay Stock Exchange in 79, today it is 81,451 as a meaning. 100 rupees invested in Bombay Stock Exchange in 1979 would have been worth 81,451 today. Or in simple words, if I last year invested 78,139, by now my investment would have become 81,450. That's the simplest meaning of index. Now we have these index numbers available. Some open, high, low, I think all of us know what it is, but you always take the clues. Now I am interested to know what's the rate of return given the stock market as a whole. So what I do? Gather this, find what is called yearly return. How do I find? Sir, if I had invested 148 rupees in 1980 in Bombay Stock Exchange, in 1 year it would have become 227. So my return is 227 minus 148 divided by 148. Right, sir? On 148, the difference is my return. So this I take. So if I had invested money in 1980, in 1 year, what is the rate of return would have earned, sir? 53%. So I take this. So last year, this time if I had invested in Bombay Stock Exchange, by end of 1 year, you would have earned 4.24%. That's what it is. Now, what do we take? Now, I calculated for 1980 till date, but taking entire period will be wrong. So usually the standard practice is 8 or 10 or 12 year average. So I take average for last 8 years or average for last 10 years, etc. You take any period. So once again there is an element of subjectivity. You can take any period, and this is the return given by the market, average return given by the market. So what was the risk-free rate? Around 7%. So market is giving around, let's say for simplicity, 12%. So 12 minus 7, approximately 5% is the premium given by the stock. The market has it. But this is the calculation what I showed you. Studies show, all these studies whatever we are seeing, presently the average premium given by market, stock market is around 7%. So see here, risk-free rate, market risk premium. So this is the risk-free rate, 7.2%. But this was a study done in 2024. So currently it's a different rate. And then it was estimated 7%. So please also remember the changes, and it won't be same. Tomorrow, a big fluctuation market, it will change. So imagine, that's where I said value is not a number, it's a range. That's all we can identify. Okay, so around 7%. And if you see KPMG study which shows global context, mention the number, it says around 4%. The market is premium. So Indian, of course, markets are offering much better. Right. But now, as a shareholder, now can I expect 7% risk-free plus 5% premium, 12% can I expect? 5% is the return given by the market. But from my company, can I expect that 5%? They may not. So what we should do, this market is premium, we should multiply with something called beta. Now, this beta, another, in finance we say it is the lifeline in finance. Anything, any decision in business, trust me, revolves around beta. Beta is a measure of risk. It's called measure of sensitivity. How to calculate quickly, I demonstrate, but then it's not required. So, what does beta say? Just to mention. So, let's say beta is 1.2 for a company. How to calculate? There are ways and means. I'll show, but we don't need to calculate also. Trading numbers are available. What it means is, if market rises by 10%, stock price of our company will rise by 10 into 1.2, how much, sir? 12%. Or if market falls by 10%, our company price, stock price will fall by 12%. So tell us, the change in market, how much will be change in the stock price? That is beta. So let's say beta is 0.8, 0.7 let's say. What does it mean, sir? If market raises by 10%, then stock price of company we can expect to rise by how much? 7%. Similarly, if stock price falls by 10% or whatever percent, let's say, falls by 5%, let's say, then stock price of a company will fall by 3.5%. That's beta. So, market is giving a premium of 5%. Can I expect the same from my company? No. So, what premium to expect from my company? Multiply with beta, which is connects market and stock. Market and beta. Now, how to find beta? Can demonstrate. Actually, I downloaded data required for that. You need daily data of Sensex, market, etc., which I have, but let me not get into that. We have ready details available. If you go to any database, beta value is given. But what is more interesting is, if you see this KPMG study, beta, we can see sector-wise beta is given, sector-wise, but there is a term unlevered beta, and this is another key component in finance, and all this, please remember, is converging into the valuation and further into enhancement. Any ideas? When I say unlevered company, levered company, what is the meaning, sir? Unlevered companies are those which doesn't have any debt. So, assuming there is no debt. Now, having debt, will it affect prices, stock prices? Yes. Every rupee debt I borrow, higher risk for the shareholders. So, stock prices rise. Stock prices fluctuate. Generally, it rises because it's expected that there is a risk. So, they expect high return. So, stock prices rise. So, it's called unlevered beta, assuming there is no debt. So, take this, which is available for Indian context as well. This is only global context, and they say re-lever it, adjust it for the debt of our company. So take unlevered beta, adjust it for the debt of our. How to adjust? There are formulae available in the folder. I made kept that formulas as well. I'll share all that with you, but honestly not required. All this readily available. If you go to any of these investment advisories, if you say beta, get a lot of details. Industries will get the details. Adjustments what to be done, you find details available. You can adopt the same, but be aware what to be considered. So I consider that and I take. So let's say for our company, I'm calculating KE. So 7% is the risk-free rate. Market is premium, let's say 5%. Now if I multiply this with beta of my company, for our company was the beta, I will get. So let's say 0.6, something like that. It could be anything, I'm just giving this an example. So I'm sure all of us know, 7 plus 0.6 into 5. So 10% is cost of it. And trust me, whatever studies I'm showing you, comprehensive study running for hundreds of pages, only about what is the cost of input. Cost of debt, this is a small component, cost of input. So if you see the HUL annual report what I was showing you, so if you could please see how HUL has calculated. Cost of equity is equal to risk-free return equivalent to yield on long-term government bonds plus market risk premium into beta weighting. So what's the formula HUL is using to find cost of equity? CA. Most adopt the same and they calculated how much, what is the beta, etc. Okay. Now having calculated this, cost of debt, cost of equity, the next component is, so I know the cost of debt based on credit rating, cost of equity using CAPM, but this is not what I use. To find value, what the discount rate we consider is WACC, weighted average cost of capital. Now, so what else I need for this? The weight of debt, weight of equity. Now what should I consider? So again, studies show, very interestingly, what to consider. Should you consider your company debt equity? Consider if you want so. But keeping long-term requirement in mind, long-term, whatever the debt ratio you have now may not be the case. So what is generally suggested is to consider target debt equity ratio. The long run what it could be. And there are studies like this which show in the long run what is ideal debt equity ratio or debt ratio for business entity. Industry wise we provide. See, debt ratio by sector wise what may be. Now how this comes up, what is the case, there is a lot of background for it, but it has been accepted. So that much work reduces, but each of these, if you get that understanding, we can do. Each industry, if you know how to analyze, how to forecast, you get the idea. This is what we call industry analysis. That has been readily made up. So that also is available. Suppose now we have with us all components, so I am ready to calculate W6. What should take more than 1 hour? I need to condense into this discussion, touching on the key points. So let us suppose 10% is the WS, just for simplicity. So what I do now, we have estimated current year FCFF, from that we forecasted future period FCFF. In this case we took corporate growth rate, G is equal to BR, or you could take an industry growth rate. We took 5 years as the horizon period, and to estimate this for the remaining period we assume 6% growth rate, but now we should discount this. So what I do, present value of 1 rupee at 10%. So all these are simple calculations, but I'm just demonstrating. So this is what I mentioned, time value of money. In any decision this is essential. So we estimate this. We get a value. Now this is the value for 5 years. So we take terminal value, which also shown what to be done. So we take this value, 6% is the growth rate. So we take this into 1.06 by discount rate 10%, growth rate 6%, something. But there's small adjustment we do. This is after 5 years. So end of 5 years, if I get 1 rupee, its value today is so much. So I multiply this further with this number. I'm not going deep into the calculation. I'm just showing you the process involved. So I have with me now the value for this company. Some imaginary numbers. Okay. Now, let's first very quickly recollect what are the inputs, because what we take from here on is more important, and trust me, the values are available. There are many ways, and there are websites, key in the data, it will give you the values. So I don't have to struggle with this. But always good to know the background so that decision making becomes that much simpler. Now, that is fine. What are the inputs? Future free cash flows and discount rate. WC is a discount rate. What all went into it? Let's give a thought. And this is exactly what we do. In my institution, we have an exclusive consulting division, and we consult on finance matters. And it's not that we had any big background, but we have a very, very clear template and framework what to look at and what to address for. And if that we can, trust me, you can add value to the company, you can help companies to enhance its value. What's the template? So, we see this very exactly, and you will see how everything you have learned in financial statements, etc., annual report is in the company. Now, our objective is to maximize value, increase value. Now, how to increase the value? As we know, value is present value of future free cash flows. So, if at increased value, our free cash flow should be higher. Bigger the number, my value is higher. If my discount rate, I'm sure we know, lower the discount rate, higher the present value, higher the discount rate, lower the present value. So, how can we maximize the value? by having higher free cash flows and lower discount rate. If both can happen, nothing like it, we can maximize the value. Can keep on enhancing the value. Then the question arises, how to maximize, how to increase, how to enhance free cash flows. So let's recollect. So free cash flows, if you remember, NOPAT, add depreciated cash flows, and reinvestments. So this is called gross capex. If I adjust depreciated net capex, so how can I improve this? If you can increase NOPAT or decrease reinvestments or both, then my FCFF will increase. Currently, what are the FCFF I have? Future, if I have to increase it, either increase your NOPAT or decrease your reinvestments or both. Now, how can I increase my NOPAT? So let's recollect. How do we get NOPAT? What's the full form of NOPAT, sir? Net operating profits after tax. So, either I should increase my operating revenues or decrease my operating cost or decrease my tax. Right? NOPAT. Now, how to increase revenues? I can't generalize here, but that's exactly what you need to identify with your clients. And this calls for, apart from all the knowledge, background of marketing knowledge, strategy, etc., all that you would need, but then at least we have an idea what to look for. But this is our area. And this is where we have expertise, the next two areas, and trust me, each of these, with the way it can be done, small things but can make very, very big difference. So, how to cost management? Just to mention one experience, this is very long back, at least I should say in 2007 if I'm right. We did one training program for Godrej Agrovet behind Manipal Hospital in Old Airport Road. And Godrej Agrovet, I'm sure all of us know, is into real good chicken and there are many products. They wanted a program on just one particular topic called marginal costing. Something simple, most of us have read it, most of us have played it, but trust me, such a powerful tool, such a powerful technique. Wherever we have trained companies on that, we have seen very, very significant improvement in their profits, in their output. So this company we did. The training was between 6 and 9 in the evening. This was from the institute. Just I was coordinating that. 6 to 9 in the evening was the program. After office hours, entire team, management team, including the attender, who was also an educated a BCom, grade D, but including him, we were present for the program because we are very keen that everyone undergoes the process. So Monday to Friday we ran the program, and for Saturday we gave them an assignment. Demonstrate in your own area how you would apply marginal costing and improve your performance. Everyone, right from managing director, they presented. But add one more product, what I will do, one more facility management, what I will do, how I decide using this technique. Excellent. But the best was the attender, the grade D worker, who presented. I keep taking copies of many documents. So, whenever I need to take the copies, should I take a printout or should I take photocopies? How will I decide? It's showed using marginal cost. Now today is not a concern because today we don't distinguish print and photocopy. I'm talking about 2007 where it was two different things, print was expensive, etc. So imagine right from the top level strategic decision until operation level decisions can be taken. Imagine the power of these techniques. And this is just one technique I'm talking about, marginal costing. And with all the development that has happened. And who knows it better than you, sir? That's something you have been doing it, you have been practicing it. And your own clientele, ask me, just seeking little information and how much value can get upon. And most clients need it because for most of the clients, focus always the top line, they forget the remaining parts. And that's where exactly we can pitch in. And I'm sure we can recognize managing cost. If I reduce operating costs, when NOPAT increases, future FCFF increases, the value increases. Tax management. How? And in fact, tax management is more about tax mismanagement. what clients should not do so that the tax burden won't rise. You are the best, and nobody else can give right suggestions. And we have seen, I'm sure you have better experience in that. Just because of some negligence and tax matters, how the bottom line has decreased and what are that. Now, all these are the focus items to improve NOPAT, and improving NOPAT will improve FCFF and value. Now, alternatively, how can we increase free cash flows to the firm? By bringing down investments. Now, reinvestments are made in what? Either in fixed assets, property, plant and equipment, or in current assets. That's what will be reinvestment. And my reinvestment will be less if I manage this efficiently, effectively. And how to manage fixed assets efficiently? So we have capital budgeting, project management. All these are areas, and many of my good friends, my old students, who don't take up any audit, accounting, their entire focus is project management. Such a huge need, and trust me, and I'm sure you can see how directly it leads to value enhancement. And a bigger cause of concern is working capital management. Like I'm sure all of us know, business today every year comes up with a study, the best CFOs. There are 4 criteria, and the first criteria, which is maximum weightage to decide the best CFO, is working capital management, 40% weightage. So imagine the importance of it. And we have seen most companies have gone bankrupt, but those who are not managed working capital efficiently. And again, this is your domain. Just by guiding your clientele on what they can do best to manage inventory, receivables, cash. It's a simple, common sense. Clients, companies, they may not have that idea, but with all the background you have, you can do the best. So imagine how you can add to value enhancement. Now, another way we can improve the value is with bringing down the discount rate. Now, how can I bring down the discount rate? By identifying the source from which you mobilize the funds, and more importantly, the cost for each one. The cost. How we can negotiate on the cost. And in a negotiation, you can bring down the cost component. That happened. A chartered accountant, a friend of mine, for his company, he is a CFO for a company. He went to bank and sought a loan, 10 crore loan. They quoted 14%, and then they said, what if they do, it will come down to 10%. So it took 6 months to make the structural changes and ensure that balance sheets are revised accordingly. We could raise the loan at 10%. And 4% on 10 crore is a huge thing. I imagine the impact on the cost. So a discount rate brought down will bring down this. What's interesting is something more. So, where do you find operating revenue, cost, tax, which of the financial statement? Income statement. Where do you find assets and fixed assets and current assets? Balance sheet, in specific assets side. Funds, where do we come across? Liabilities. In simple words, income statement, balance sheet. So, if we know and if we can guide our clients on how to manage each component in the 2 financial statements, knowingly or unknowingly what we are adding up to. So, what matters is managing financial statements. So, we prepare it. We help our clients prepare it. All that's one side, excellent. Now, how much we can go beyond it with the key difference lies. And income statement, there is a metric called profitability. How do you measure profitability, sir? Bottom line by top line. So, in income statement, the metric used to identify the performance is profitability, which is bottom line by top line. Assets, we have a metric called efficiency, which measures it, and efficiency is measured by operating revenues by total assets, and liabilities, the metric is called risk, which is measured by total assets by shareholders' funds. Now, what these ratios, I'm sure they're all familiar. Now, if you multiply all this, you can see net income divided by operating revenue. Operating revenue by total assets, operating revenue gets cancelled, total asset gets cancelled. What remains is net income by shareholders' funds, which is nothing but ROE, return on equity. So, simple words. Return on equity is a proxy which indicates. So when return on equity is given so much importance, everywhere it's mentioned with hue and cry, for a simple reason. An increase in ROE indirectly indicates there is increase in value. A fall in that indicates there is a further value. So it's considered a very huge metric, and this link what I gave you, ROE, profitability, efficiency, and risk, I'm sure all of us is called DuPont model. And there's something even more interesting. Now, all items that get recorded in income statement can be generalized as operating activities. Operating activities. Assets are called investing activities, and those related to liabilities are called financing activities. Where do we come across these terminologies, sir? Cash flow statement. And if you know how to read a cash flow statement, you will be surprised. A cash flow statement is not about where the company is getting cash from, where it's going actually. It's all about, is the company adding value or eroding value? A glance at it, you don't have to even read the numbers. Numbers is irrelevant. Glance at it, you can say, my company, HUL, Infosys, whichever it could be, is it adding value to shareholders or eroding the value of shareholders? To quickly show you this, let's say this is the template of cash flow statement. All of us know opening balance of cash and cash equivalent, add or less net cash flow from operating activities, investing activities, financing activities. What are my net cash flows are? Cash inflows minus cash inflows. Now when net cash flow from operating activity plus, it means operating revenues are more than operating cost. It means company is making operating profits. If net cash flow is negative, it means it's incurring losses. Investing activity, inflow comes from sale of assets, outflows towards purchase of assets. Net minus indicates company is investing, plus indicates company is selling assets. Net. Financing activity, inflow is from issue of shares, issue of debentures, borrowing of loans, etc. Cash outflows is payment of interest, payment of dividend, repayment of loan, redemption, buyback, etc. So net could indicate. Now, how to read a cash flow statement? Look at any company cash flow statement. Observe what is the symbol for the net cash flow. Suppose for a company it is plus minus minus. What does it indicate, sir? It indicates company is generating profits from its operations, using which it is investing in assets and meeting financial obligations. Most ideal situation to have, and this is what we find regularly because such companies are value-adding companies. So cash flow statement indicates that. Let's take another extreme. Let's say this is what we see, minus let's say this is the symbols, and I'll show you cash flow statement companies which are all these minus plus plus. What does this indicate, sir? Company is incurring losses in its operation, which it is making up by selling assets and borrowing funds. Extreme worst situation to happen, which should not be the case. Such companies are called value eroding companies. Suppose, so if you see Reliance 2 years back, this is what we could see, but last year there is a different improvement. So let's say, sir, this is the symbols what we see, plus minus plus. Generating profits from operations, borrowing funds, investing everything in assets. Such company are into expansion, what we call as growth companies. So what's the nature of company, what is doing to shareholders, you can identify from cash flow statement. That's the actual purpose. There's a beautiful book, which I also include in this folder. Business Analysis and Valuation Using Financial Statements. That's the title of the book. Business Analysis and valuation using financial statements. It's written by Krishna Palek. I have a soft copy, I add that. Whatever I explain now is what you find there. I'm sure most of us would have read Robert Kiyosaki, Rich Dad Poor Dad. And there is one more book of him called Cash Quadrant. Wonderful book. And in fact, for a common man it's difficult to understand, but you know about accounting, finance, etc. It's something which you will enjoy reading. You will see simple strategies. Looking at financial statements, looking at cash flow statement, how you can decide what is happening and what can be done. Imagine the kind of knowledge you can get, and if you can help your clients with these, where can we do? No. So I'm just trying to hint you that cash flow statement, looking at it, you can say what our company is doing, and I want you to see the connection. How everything needs to be. In fact, because DCF method not only helps us to find value, if you decompose it, it also tells us what drives the value and what needs to be done to ensure that we call this as the excellent or most popular technique to find valuation, because it not just end with valuation, it goes beyond. This is a glimpse of DCF method. Now, what could be the challenges in this? Suppose a company is incurring losses continuously. Losses minus profits. Future also we don't know where it may go to. Government companies where profit is not the motto. Can you use DCF method, sir? No. Future FCF negative. Can you have negative value? So there we can't use DCF method. So usually go for, if it's government companies, we go for net assets method, very logical and meaningful, or we go for comparable companies method, relative method, multiples, corporate multiples, which itself is very interesting discussion. Particularly EY, we have exclusive department, multiples department, which is into valuation only using this method and kind of depth that we have. Suppose it's a private limited company. Whatever I explained till now holds good for a public listed company. Private company, what you think we may not be able to ascertain, sir? Which of these could be a constraint for us? So this is what we need to find the value. It's a private company. Where could be the constraint? What could be the constraint? Beta. So cash flows, future cash flows, fine. But we need to make various adjustments. Because it's a private company, there's some liberty in its accounting. So first it should be standardized as a public limited accounting. For example, the salaries to the, let's say, two shareholders, it's husband and wife are earning it. So they have their own remuneration mechanism. And for private limited companies, manager remuneration provisions are not applicable. But value, if it were to be listed or public, what should have been? In accordance with that, we need to readjust and calculate FCFF. Discount rate, cost of debt, it's okay. But cost of equity, we don't get beta. What should I do, sir? So that's why I said, we have unlevered beta available for industry. Relever it. And today, classroom we discuss how to find unlevered beta relever. It's simple mechanism. As I said, there are websites available. If you input the data, you will get what is required. But keep in mind, what is unique in that context. Let's say it's a new age company, a software company or some such company, where you can't actually even have a clarity what's the future. How many of these new age companies, what we see, we don't know what happens tomorrow. Was a business model you can't even read. That's what Warren Buffett says. I don't invest in technology firms because I don't understand the model. That's about it. He is the biggest holder of Apple, all the traditional companies he holds. Technology firms, couple of cases he has invested a very minute stake. Why? For simple reason, he says I can't understand. Till recent past, how many of us know Facebook and Google, what are the revenue sources? Even today we don't have that clarity. So, such cases, how to find the value? Banks, how to find the value? Financial services, banks and financial services. This template as it is holds good? Absolutely not. all these are the extensions. So and everything lies in these two components. So in this context, what should be done to component 1 or what should be done to component 2 or both, if we can identify what needs to be done. Again, I have a soft copy of this book, 2 books. One is called Damodaran on Valuation. Classic book. As I said, the Dean of Valuation. Every scenario is visualized and given templates what to be done. And he has written one more book called Dark Side of Valuation. What are the problems we could encounter, how to address them. I will include that and pass it on. Just read that. Trust me, it will open a very big new world for all of us. How to find value, and that will give further direction on to our own clientele what we can do to enhance value and take it. And there is one more article from Harvard called Corporate Multiples, and one Indian context also I will put it later, which shows step by step how should I go about finding value using relative methods. And what is relative method? I can't find value for my company. So based on the value of another company, find the value of my company. So comparable company and multiple. How to do that? What multiple to take? What ratio? Step by step, it has given how to do that. Whatever given there holds good in any context, Indian context as well. Just this makes a difference. So, DCF, very brief. It's intangible assets, how to find the values. Firstly, let's say brand, human resource, intellectual property. So if it's intangible asset, how to find the value? You can discount and charge. So discount rate, okay, that's a part. You can go with WACC, which is standard. Where will the challenge be? What could be the free cash flow it can generate? How to estimate that? So there are ways and means. There are templates available. There are based on companies which have tried to find value for intangible assets, how it has to be done. There are some framework available. Now, is this framework foolproof? Absolutely not. But based on experience, sessions have been done. How to find value for preference shares? So preference shares is very simple issue. But convertible preference shares has something to be addressed because it's an option available. So for this we need to know what is called real option valuation. Simple again, but also a little background of option valuation. So little knowledge on derivatives can help us. But with just preference shares per se, just debentures per se, present value, future inflows. And preference shares, debentures, all this, we know the horizon, we know the inflows available, it's easier to find. If it's convertible, then we need option valuation. In the material shares, even there is something available on that. So once you get to read that, then you get an idea. It's converted preferences out there. This is a glimpse of how to find value for business activity. Now, as I said, my purpose is not to show the valuation, but us what the relevance of this, and if we can't add value to our clients, it's not a complete service. That's what I always believe, and clients count upon us. That's always what I've observed. Where all we can add and how we can add, one of these areas is good at operating cost, tax. Each of these areas, if we can make a small difference, it leads to big change in the value. That is our contribution. But if we know consciously that whatever efforts we do as a link with valuation, it becomes even more meaningful, and our efforts can be even more directional and focused. So that was the intent and the purpose. And as I mentioned, my friend who is a property valuer, he gets so much of offers for corporate valuations because all the big wigs are unaffordable. Small firms, they can't afford it. They can, but not the fees what they charge. 4 lakh, let's say, is an extreme. In half an hour work, 1 hour work, even if you have to charge, whatever the numbers, it's not about the amount. Imagine, there's a huge need, there's a constraint, shortage of supply in this domain, such a need, and my friend keeps saying, I need somebody, but it's not happening. Fortunately today, there are a lot of certified valuers coming up. Many international professional courses which are being offered, CVA, Certified Value Assurance something. So many such courses are coming up. One, that certification opens doors for many other opportunities. But then, what I tried to show was that these are opportunities available and not just valuation per se, but even beyond how we can add value to our trading system. So I end with again the same quote which I mentioned earlier. Cost is a fact, profit is a policy, price is a policy, but value is a notion. So while all the discussion we made, end of it, can we conclusively say this is the value? Impossible, it can't happen. But as long as we get an idea what could be the value, a framework, a range, that's a good effort by itself. And that's exactly what happens. So mergers and acquisitions, synergy, that's one more, we get the value. Again, all these fall within the same framework. So how to negotiate? So each of us, both the acquirer and the target company, come with their own value set, negotiate. But how at least to arrive at that is what we can think of. Is a brief presentation of that. And now open the questions.
Just one question.
So please.
Suppose FCFF divided by DR minus G. If DR become less than G, then the denominator will be negative.
Excellent. Wonderful question. What is discount rate, sir? Again, by meaning rate of return expected. KE is rate of return expected by shareholders. WCC, discount rate, is rate of return expected by all those who fund the business. If growth rate is high, there is no possibility that discount rate will be low, because higher the growth rate, the expectation of investors also will be higher. So discount rate also will increase. So it's correct. So by numbers you may see that happen, but in reality, as the growth rate increases, as an investor, my return, what I expect also increases, discount rate also increases. So practically coming to a negative value will not happen because of this issue. Yes, sir.
Now we have come across the short time. So how do they value the business? They are all budding
Yes. In startups, excellent. Startups. Now this is another issue. So in this book which I'll share, clear templates given for startups, how to find the value. That's been provided as well. Startup comes with lot more assumptions. And if it's in a related, known, established area like fintech, etc., today which is known, at least there is a direction we have what to consider, what to assume, to estimate, you have an idea. There are so many new things coming up, and as I said earlier, quite often you don't know the business models. So what to assume? So what suggested is DC method may not always be useful. There are other methods available. So for a short period of 5 to 8 years, go with those other methods. Then come back to this. But is it simple? No. But then you have to find a value. So we do. But comes with a lot more assumptions. What are the kind of assumptions? This material what is shared, I'll request Girish to see that it's all shared with all of you. Please read that, you'll get it. So that's exclusive one specific area. Young startups, how to find them. Startups, 10 years, till 10 years startup, but young startup, first or second year, how to find them. Can you even find a value? You should ascertain. If you can, what assumptions to make. So there are what is a framework available.
So free cash flows.
Sir, please.
Free cash flows.
Sir?
Free cash flows.
Free cash flows. Yes, sir.
So is it after the investing activities or after the financing activities?
So it's only after reinvesting into assets. Financing is not part of free cash flows. If you remember, interest was not given a
For
consideration.
the valuation purpose.
For valuation purpose,
So
exactly.
it's applicable after the investing activities.
Only after investing activities, not financing. In fact, the financing gets captured in the discount rate.
Oh, that's what I
Why have the interest been removed? Because interest is very much part of the business. We are using it for business. So why you are not treating it as an operating?
Actually, sir, interest, as I mentioned just now, gets captured under WACC. So it's not that it is ignored, but it is considered under WACC, cost of debt. So So it is considered. But there is an alternative method. Suppose in calculating cash flows, you want to consider interest. We can. But then discount rate should not be WSAC, it should be KE, cost of equity, which gives the same results actually. So it's not that it should not be, but there is a usual template, ignore it there, capture it under WSAC. So I immensely thank once again Mr. Manjunath for this opportunity. Thanks for the interest, thanks for the active participation. And of course, a lot more to share, but time is a constraint. But I'll share all the content and the material that I have here with me. It will be very helpful. And in case, if you feel I kind of any assistance in any of your discussion, please feel free to mail me to this email ID. I'll be more than happy to connect and discuss the details. So it's drkumar27@gmail.com. On this or anything in finance, if you feel any related area you would like to get some inputs. Thank you once again. Have a great evening.
Members, I have an announcement to make. We have a students' national conference on 6th and 7th. Please pass this message to members. They are already having around 1,700 members. Students who have registered. They are expecting around 2,300 odd. So just pass this on information to those students and chartered accountants who can further discuss it on. Yeah. Thank you, sir. Thank you, Rajesh sir. It's my privilege to give the vote of thanks to you. The presentation was quite interesting to all the members, I believe, and the knowledge dispensed of can be well taken by all the members. Yeah. May I call upon the chairman, Sri Manjunath Hanusa, to present the memento to the speaker. Thank you, Chairman, sir. Thank you, members. Have a good night.